We are pleased to be welcomed this morning by Neil Kashkari, Minneapolis Federal Reserve President, a longtime friend of Squawk Box. Neil, thanks for being here.
Thanks, Steve, for having me.
Great. Listen, normally I'd ask you right away about the jobs report, but we were just having a conversation about the gap between what the Fed has been doing in terms of lowering interest rates and the behavior of the 10-year. And I'm wondering, as a Federal Reserve policymaker, a guy who used to work at Goldman, used to save the country working at Treasury or help save the country during the great financial crisis, what you make of the behavior of the 10-year, how worrisome is it to you as a policymaker? Of course, now it's eased back a bit from where it's been.
You know, it's not worrisome, but it's important to try to understand what's driving it. So I spend and my colleagues spend a lot of time trying to dig into the details to understand the moves. As you know, since we started cutting rates in September, the 10-year didn't go down, it went up. Right now it's up about 80 or 83 basis points relative to where it was when we started our cutting cycle, which is counterintuitive. When I dig into the data, around 40% of that move is in inflation compensation, which ultimately we control. You might interpret that to say markets saw a more dovish than expected Fed and then boosted inflation compensation a little bit. I'm not worried about that. We will get inflation down to 2%. We're committed to that. The balance, the other 60% of it, is really about real rates and what's driving long real rates. There are a couple explanations that I'm focused on. One is I think there's great uncertainty about where the neutral rate is. And the longer the economy continues to exceed expectations on growth and resilience, I think people and markets are taking signal that the neutral rate may be higher. And then you've got the residual, or what we call the term premium. That a lot of things go into that. One possibility is fiscal deficits, larger deficits, all else equal, would tend to tick up the term premium. And so where does this all shake out? We're going to get inflation back down. But then ultimately what the executive branch and Congress do on the fiscal side, and ultimately what our growth trajectory is, are we in a period of higher productivity and higher investment, that would tend to push up long rates. And so how that nets out, we're just going to have to wait and see. But we're going to get inflation down.
Neil, I want to come back to the 35 questions I have over what you just said in a second. But people right now at this moment are trying to make sense of some enormous numbers that were just laid on them. 300,000 plus in December, revision up. 149, a touch below, but right around consensus for the January numbers. Huge revisions on the household side. Big downward revisions on the establishment side. How do you make sense of all this? Tell us where you think the job market is right now, since you have a mandate for low unemployment.
Yeah, I think of all the data that we just looked at, that you just mentioned, and I have to go through the details, right. I think the most important one is 4.0% unemployment rate. This is still a good labor market. It's not as hot as it was a year or two ago. And I validate this data by talking to businesses all around the region and around the country. And overall, the feedback that I'm getting is the economy is strong, businesses are optimistic, it's a cooler labor market than a year ago, but they're still having to work to find the workers that they need. And so I think the economy's in a good place. We want to keep it there while getting inflation all the way back down to our target.
Neil, it's interesting you say what you said, because a wise person told me once that you can look at all the data you want on employment, and maybe the one thing you really need is the unemployment rate, and that tells you exactly what's going on. So that really dovetails nicely with that. And Neil, before Becky, I did it again. I'm sorry.
We had a Betsy.
Wow.
I'm sorry.
I heard about this.
I heard about it.
I heard about that. I wasn't
Never mind. Before.
Oh, I want to hear about that.
But he also has a producer named Betsy.
And I was emailing her at the time. Now I gave myself a jinx. Okay. Yeah. Becky, Joe, and Andrew, real quick. We had a weekend full of drama, Neil, when it came to tariffs. How did you spend? What were you thinking over the weekend about the impact of potential tariffs? They're delayed now for 30 days. How does that affect your thinking about where policy can and should be?
It reinforces my view that we're in a good place. My colleagues and I basically have said we need to wait and see. We don't know enough information about what's going to be announced. We have a little more information now on that. We really don't have information about what will actually be implemented and how other countries are going to respond. And in that environment, we shouldn't guess. We should just wait and see. And then the good news is, as we just talked about, the economy's in a good place. So we're in a very good place to just sit here until we get a lot more information on the tariff front, on the immigration front, on the tax front, et cetera. All of those are going to be important.
So what's
the next data point you're watching for? Or is it watching the headlines and kind of seeing how it all plays out?
Well, setting aside the policy uncertainty that I just mentioned, the other big question is, we've seen potentially residual seasonality in the inflation data in the first quarter of the last couple of years. Is that going to be repeated? Or if you look at the last 9 months of inflation data, it's very encouraging, but first quarter of 2024 was very hot. Is that hot period going to be repeated, or is that going to roll off? If that rolls off and the recent inflation data continues, then we should see rapid disinflation in the numbers in the first half of this year. And so that, for me, is setting aside the policy questions. That, for me, is what's of paramount importance right now, the first few inflation prints that we get. So
can you cut, Neil, if you get that inflation down where it needs to be, even with the uncertainty over policy?
It's a good question. I think we'll have to see where, what that uncertainty looks like. What's the range of the negotiation that's taking place? And obviously, tariffs are hard because it's not simply what we do in America. It's how other countries respond and the back and forth. And so I think the tariff one is particularly difficult. I think the other pieces, tax policy, maybe we'll have more clarity on what the outlook looks like on taxes and revenues and spending, and that may give us more comfort. Ultimately, our job is maximum employment and stable prices. And if we see very good data on the inflation front while the labor market stays strong, then I think that would, for me, move me towards supporting easing further. I don't know why we'd have to keep rates where they were if we really saw inflation coming down quickly.
Neil, there are people who would complain and say, hey, were you this sensitive to fiscal policy under the Biden administration? Is there perhaps a double standard here? Why are you holding your powder now with Trump about to do a bunch of fiscal policies, but didn't really seem to react to when Biden passed these massive spending bills?
Well, it's a question of what's the underlying inflationary dynamics. Going into obviously the huge inflation surge, we had about 1.5% inflation for 5, 6, almost a decade, and the concern was, could we get inflation up to 2%? Then we were surprised we had this big inflation surge. Inflation is still above our target. It's running at around a 2.5% rate right now, and we need to get it all the way back down. So I think given the recent history and given everybody's and my belief in the paramount importance of keeping inflation expectations anchored, we have to finish the job. And so I do think our look at the fiscal policy is informed by our recent experience and where inflation has been running in the economy.
Yeah, it's like, we had no idea inflation was coming, and God, that was crazy, all that spending. Since we had no idea inflation was coming, we didn't know all that spending was going to cause it. And now you're saying, well, now, fool me once, my fault. Now it can happen. I mean, things do have an effect, right, Neil? I mean, what are we still up? We're still up 30% in prices, are we not?
22.
Yeah, I mean, overall, the price level's up a lot, and that's why Americans are frustrated, and I share their frustration with that. But our job is to get inflation down, as you understand.
Maybe that's all.
Supply chains.
It's just there are real effects to what we do, and we forgot it for 40 years. It's like we thought we could do anything.
Well, I think we were surprised we had not seen the supply-driven inflation in a long time. And given all of the geopolitical uncertainties in the world, could there be supply shocks that hit us again? It's certainly possible. We're certainly much more aware of that risk than I was 5 or 6 years ago. And so we shouldn't forget that.
Yeah. Neil, give us your best guess of how policy shakes out this year. Do you think you end up the year lower than where you started? And will inflation be coming down and hitting target this year, or is it next year?
I think inflation, the underlying dynamics are coming down. We have a lot of confidence. Housing is still a big piece of the inflation. We have a lot of confidence looking at the new leases and it takes a couple of years for that to roll through the actual inflation data. So that should be helping us bring inflation back down. Barring something really surprising on the tariff front, immigration front, or fiscal policy front, so taking off some extreme outcomes there, I think inflation will continue to come down over this year. So all things equal, I would expect the federal funds rate to be modestly lower this year, at the end of this year, relative to where we are right now. But of course, the data is going to drive that. And we may not get officially mathematically back to 2% this year, but hopefully we'll have a lot more confidence that we're almost there going into next year.